Atul Suri joins us now. Let's take a conversation forward. Atul, fantastic to have you back. Atul, there is this big shakeout which we saw at the beginning of December. Then markets made a comeback. Then we were off to a great start in Jan, and towards Jan end we saw mid-air turbulence. What is going to be the nature of the market for rest of the year? Will it remain volatile, choppy, or this so-called mid-air turbulence, it's a matter of time that will go away and it could be back to clear skies?
I think what we are going to see is a period of consolidation. And we did some work, we put out a paper on this a few months ago. What we've seen is that post crashes, like whether it is a 2000 or 2008, sorry, it's not COVID, don't worry, it's just the weather. So whether it's 2008 or 2000 crashes, post that the markets tend to spring up. We had a spring action in 2003. We had a spring action in 2009. And again, we've had a similar spring action in 2020. This is when the big falls have happened and the markets have pulled back. So that's like the first phase of the bull market. But post that, you'll find that markets need to consolidate. Markets need to absorb the kind of move. We cannot replicate the move we've had last year for years to come. So what I feel is that we will get into this phase of consolidation. It could last a few months where we could be in a range, where we hit a range of 18 and a half, 19,000 on the upside, 16 and a half on the downside. In this, you'll see sectorial change you guys have been talking about. So I personally think that we are going to see this kind of play that will elongate for some period of time. Sectorial rotation would happen. And there are dark clouds at the moment, whether it is bond yields or whether it's crude prices and things like that. So these narratives will keep happening. They will keep you occupied. They will, as I say, that this is going to be a year of kabhi khushi, kabhi gum. So what we are really going to have is that when we get really euphoric and feel that the breakout's going to happen, it's going to blue skies and it's going to disappoint. And when we're going to say like, oh, nothing is happening, it's all, this problem, that problem, the markets will surprise you on the upside. So I think that this is going to be a period of consolidation. Has happened in the past. It is classic. It's statistically proven. And that's fine, I guess, for people who are paying the longer term trend. It may be a great period for certain amount of rotation within the portfolio and the time to really identify the new leadership that emerges and to realign the portfolio in that space.
Okay, now Atul has done a lot of work on chart analysis, and we'll show them to our viewers. I'm going to start with perhaps the most important, the ultimate chart which everybody wants to understand, which is the US 10-year yield. Now, Atul, while we may talk about Fed and inflation, but there is a technical side to it also. Is that has the 10-year paper now structurally changed its direction? It's at 2 right now. Let's use that for a reference. Where is the 10-year paper headed? The US 10-year yield.
So if you really look at, not talking about a week, a day, but if you look at the mother of all charts, I think is the US 10-year bond yield. I mean, it's if you take a 40-year move, US bond yields are at 13% or thereabouts. So what you will see is that for the last 40 years, the bond yields have been actually in a very, very systematic way, sort of declining. There's almost a parallel channel that has played out. However, when COVID happened, the US Fed really went into an overdrive, and you'll find that bond yields, kind of cracked to almost 0.5. So what you really see is that a channel that has been playing out for the last 40 years suddenly got violated. And that big kind of thrust down happened. Now what you are really seeing post that is a pullback. A pullback has to happen because you can't have, COVID-like situations, in reality, where bond yields are going to be like almost reaching negative for very long. So now what we are seeing is a pullback, and we are again getting back into the channel. So I know there is a lot of chatter of bond yields. There's a lot of chatter of that the whole interest rate cycle has turned. But if you really take in a longer time frame, like kind of 40 years phase, you'll realize that actually it is nothing but that the excesses that happened in 2020 due to a very special event which really has pulled back. And that is where we are back in the channel. So I really don't think that, there is a complete reversal of the interest rate cycle of the whole 40-year trend. Yes, excesses that happen on the downside are getting corrected. And that is really what is being felt. And that is really leading to the kind of move that you're seeing. This whole move away from growth right into value. I mean, growth stocks are finished. Yes, they've been through a correction, but I really don't think that growth is finished. Growth investing is finished. You do have excesses, and the corrections have happened. These excesses also happened in the markets, where anything to growth. I mean, companies with disastrous numbers, no earnings, just good storytelling. You saw the NFTs, you saw all the meme stocks. You saw how they really went up, and I think those excesses are getting corrected. So I still maintain that we are in a longer term downtrend as far as bond yields go. Yes, their excesses are getting corrected, and ultimately I feel that it is growth investing which may have had a bit of difficult months, but in the long term I think that is the way wealth is created.
Why do we always use this very loose reference of growth versus value? I mean, I can talk about a pharma company which is growing cheap, which is growing, and is still looking cheap. And I can also talk about a old company which could be a cement company or a power company which is not growing but is value but does not grow. This is very loose, this or that kind of an approach in the market. या तो growth लो या value लो. Can they both coexist for next couple of years?
In fact, they can transition. I think that's a very lovely question. Most of us think that this, like cement, is old world value. It need not be the case. Growth stocks become value if some of these growth stocks really correct, which many have 50-60%, and you've got earnings to back it, they become cheap, they become value. And a lot of companies or a lot of sectors or themes which are traditionally considered as value, some of the cyclical plays. But if the earnings change, and they have, and they're able to persist with these earnings for periods of time, they become growth. So growth and value are not defined. The company cannot be either this or that. Companies can change pockets. What is growth? Growth is when you're growing faster than the overall market. What is value? When a stock is valued when you are trading below the intrinsic price or whatever's fair valuation, and these things kind of move. So I'll again put it very simplistically. In India, we really don't have a growth index versus a value index. But if you look at the US, you'll realize that since 2008, there has been almost a 14-year secular outperformance of growth stocks versus value. In fact, very good proxy of growth is the NASDAQ, and a very good proxy of the value play is actually the Dow. So even if you do ratio charts, that's a very interesting way of playing out. If you play a ratio chart between growth and value, or between NASDAQ and Dow, you'll find that for the last 14 years, growth or the NASDAQ has outperformed value or stroke Dow for the last 14 years. And as interest rates have gone up, in the last 6 months or 1 year or thereabouts, bond yields, let's put it that way, you'll find that you will see that value stocks have sort of, pulled back a little bit. Growth has taken a cool off. But again, these are very, very sort of, loose definitions. However, in the longer time frame, ultimately markets value growth. Ultimately, it is growth that is going to get rewarded by investors. We invest to grow. We invest for our money to grow. And that is why we will get into the growth space. So what could be value today can be growth tomorrow, and what is growth tomorrow can be value. So I think that this very, very interesting play is panning out. And I, for one, continue to have a very strong conviction towards growth. I still think that, a lot of stocks which are backed by very good earnings or fundamentals which have corrected, this is a very, very good time for us to really, go and pick those stocks. So that's really my understanding or thesis at the moment.
Good morning. This is Nayantara. So, we had Mr. Rakesh Jhunjhunwala on the channel recently, and he told Nikunj that valuations are a slave of earnings. And as we are having this whole value growth conversation, and if they can merge, what we did see in 2021, and which brought a lot of first time investors to the markets too, was the IPOs of the new age companies. But what we're also noticing is that since their listing, losses are only widening. It happened in the last quarter. It has happened this quarter too, from a Nykaa to a Policy Bazaar to a Zomato. How to look at all of this then?
So as far as in my playbook goes, I kind of avoid all these plays because, as Rakeshji rightly said, that ultimately markets are a slave of earnings. Prices are a slave of earnings. Very often, if prices go up, which are not backed by earnings, the end tends to be a little bit of a disaster. So the first and foremost rule or principle, which I have learned over 30 years of lot of mistakes, let me tell you that, is that you need to have companies that are backed by earnings and earnings that are accelerating. And I think that will find reflection in stock prices. Sometimes stock prices go up, the earnings are not there. Sooner or later, markets will correct, and you will find that that kind of play out happening. And you're not just seeing it in these 5, 7 names that you mentioned, Nantara. You look at the US, you look at the kind of corrections. I mean, marquee names have corrected 50, 60, 70%, and nothing much has happened in the index really. So essentially, I, for one, in my playbook, am very, very clear that it is earnings that drive prices. And if the earnings are missing and prices are going up, I'm very, very okay to sit by the side and watch it go. Because sooner or later, we know when corrections happen. If there are no earnings to back it, it ends. I mean, concept stocks, all these things are great things. You may get some right and you can make a big story about it, but 9 out of 10 times it's going to end very badly. So I am one of those guys who definitely does not have the appetite to have those disasters in my portfolio. I would rather miss away a good so-called story, etc. But the base principle being that there it has to be backed by earnings, and if they are not there, I'm not in it. So that's why the names that you mentioned, I'm not in it, simply because till they don't show me the earnings. And the beauty is that, I have seen again through history, whether it's a FANG stocks or whatever, like let's take Apple, the most marquee name that there is, in the global equity markets. You'll realize that it's not a newly listed stock. It's been around for ages and it's done nothing. It's been a disaster of a stock. It's only when there were sustainable earnings that the stock rewarded investors. I mean, someone like the great legendary Warren Buffett could, get into the stock so late and make it the most remunerative investment in his life, in spite of being a late stage investor, simply because what came were earnings, what came were sustainable earnings. So all these stocks you mentioned, some will be hits, some will be misses, but only and only when they give me sustainable earnings will I be in them. Otherwise, I'm okay to sit out, because my experience or history shows me that the ending is never too pretty, actually.
Hi there, Atul. Morning, and that's clearly what we seem to have, culled out by way of data as well. Some of these new age tech companies this time around as well have seen their losses widen. Paytm, Nykaa, IndiaMart, awaiting Zomato as well. Would you add consumer discretionary to this list, perhaps minusing the auto stocks, talking a little bit about how the valuation as well as earning risks persist when it comes to this space?
No, I don't think so. I don't think that consumer discretionary has any sort of play, has a very similar case. I don't think so. I think they're backed by earnings. They are cycles. They are companies that have been around. Yes, you have economic cycles. You have commodity plays that go in. So you have a few big, good quarters, bad quarters. I mean, look at steel, classic. I mean, again, a sector which was considered as a dog, but such spectacular numbers and such, excellent performance you are seeing. So I really don't think that, consumer discretionary, some of the commodity plays, etc. I mean, look at PSU banks, again, a decadal underperformance for 10 years since 2008. You have just lost money. You just lost money in PSU banks, but you'll realize that, as and when the earnings have come, you realize the kind of price movements that happen, the investors are making money. So the whole principle of earnings driving prices is, written in stone for me. And that you will see in sector after sector. And it's only when markets go sideways, which was actually the first question that Nikunj raised, that when markets go sideways, the market goes through this realization. This is the cleanup process, and this is when the portfolio churns happen. See, in a bull market, everything does well. In fact, the saying is that gada ghode se tez bhag jata hai. That means very often the donkey surpasses the horse in a bull market, because it's all about storytelling. When the markets go into consolidation, the storytelling ends, and that's when people start looking at earnings, and that's when you start seeing this kind of re-rating that happens. So I think this is a very interesting space for us as investors. This is a space for us to actually relook at our portfolio, and we could have also, made some mistakes, or companies colors or performances would have changed. There'll be fresh realization. Commodity prices are rising. We have to see, those companies that can pass it on, cannot pass it on. And this becomes a very good time for us to relook our portfolio, churn and replace, because this is where the leaders of the next stage of the bull market are set. And I feel that the next stage of the bull market to come will be much sweeter because it will be much longer and elongated than what we saw in the last year or two. Last year or two was, what I call a real oversold rally. But I feel leadership is going to emerge in this consolidation, and those sector stocks that deliver in these difficult times are ultimately going to be massive, massive leaders. So I think it's an interesting time. It's a time when we are doing a lot of research. A lot of churn could happen in the portfolio. But the important point is it will set your legs, the base for the trend that is to come ahead, or a very big bull market, which I foresee coming beyond this consolidation.
And when do you think that is, Atul, and what do you believe would be the factors that would drive that bull market run?
See, one really doesn't know the factors that will come, today headlines is crude, and it's somewhere it's Russia, Ukraine. So there are so many, macro factors that are at play, whether it's going to be the Iran and US talks, which are going to ultimately bring about supply. It's a whole commodity issue, which I think is very, very important, because why I feel commodities are important, because they are the basic fuel for inflation at the moment. And I feel that this commodity inflation is keeping prices higher, and these inflationary pressures are going to tell on the Fed policy, on the liquidity that the markets are getting provided from. So for me, if there's anything that I see or what concerns me in the morning, definitely is how commodities are playing out. Because if commodities tend to kind of have this kind of euphoria or buoyancy, you will see that translating into inflation. So I think that this play is really what is important. Though I feel that excesses are getting done in the short term on this side also, and there would be a correction. But I feel that the play of commodities, the play of inflation, and the monetary policy that comes are the big macros that are going to be driving. As I said, that none of us are experts at it. We don't know. So the markets will really tell us. They speak to us. Companies who can adapt to the new environment. The numbers will show up, and it's our job to react to that. That's all there is. Trying to predict what Russia is going to do with Ukraine is beyond me. But ultimately, for me, what matters at the end of the day is what is my portfolio, what are the companies, how do they deliver, and that's I think how we look at the markets. That's how we look at trends. But I think it's interesting times to do a lot of research and a lot of churn in the portfolio.
All right, also appreciate your time. It's been we've covered a range of topics from 10-year bond yield to what you should be focusing on in terms of in portfolio construction and style. Really appreciate your time and have a great day ahead.
Thank you.